Hello, my name is Przemysław Kwiecień. I'm Chief Economist of the XTB. You're watching weekly trading webinar. Today we'll discuss bond markets and bond yields and how they affect various markets from gold through FX to indices and how it all may develop, how the Fed's president tried to kind of support markets last week and not really succeed to the 100%, but how the Reserve Bank of Australia managed to improve sentiment today in the morning. So before we move on to more technical stuff and deeper market analysis, let's start with our typical coverage of top news, everything that's the most important today in the morning. So still bond yields are in focus after a very volatile week where 10-year treasury yield increased to 1.55% on Friday morning after a couple of factors actually. Strong US durable report on Thursday, which kind of reinforced this inflation story, this inflation trades where a lot of transfers and reopening economy can translate into higher prices. And on the other hand, we also had not so successful 7-year bond offering in the US as well on Thursday, and that all caused a small market scare despite President Powell, as you can see on the picture, trying to support markets, saying that inflation should remain below the goal for at least 3 more years. So pretty much he tried to signal that, well, rates will be at 0%. And the QE will be there probably as well for another 3 years. Will he be successful? We'll discuss that in a minute. More successful was Reserve Bank of Australia that intervened on the bond market for a second time today and actually managed to push down yields across the board, not only in Australia but pretty much everywhere, supporting equities and gold prices, which we'll discuss in a minute as well. Gold prices dipped below the key support last week, but just trying to recover today. And last but not least, very strong market calendar this week with some PMIs already behind us. Better in Japan, weaker in China, but not big differences. A wide range of these indices today and on Wednesday, including the US ISMs, and obviously the most important from a market perspective is labor market in the US. ADP report on Wednesday and NFP Friday. On NFP on Friday, and we'll discuss this in detail towards the end of our webinar. So let's start with the bond yield story. Why is this important and why are these yields on the rise? So first of all, let's start with the rise question. Why are bond yields rising? Because you could ask, well, the Fed is still purchasing record amounts of treasuries and mortgage-backed securities. So shouldn't the yields stay at historically low levels? Well, technically this is obviously a very strong factor, but there are other factors to consider as well. So first of all, markets expect inflation to accelerate. This is something we already discussed on a couple of occasions where markets paid very little attention to the inflation. However, right now the story is gaining traction that actually with all this stimulus that could be too much in the US and with commodity prices on the rise, inflation could accelerate and stay at higher levels. So obviously we'll see springtime months, summer. This will be very important to judge whether this happens or not. However, the risk is there and markets try to anticipate that. So that's the main reason. Secondly, in spite of record quantitative easing and a lot of cash that Treasury, with a huge help from the Fed, managed to hoard last year, the Treasury will still need to borrow at least $1 trillion of US dollars on the market because the deficit will be so big this year because all of these Biden checks are, they need to be financed somehow. And obviously the Fed is doing a lot of work here, but that's still not enough. So if you need to borrow money, obviously those that will lend to you, they may require slightly higher yield. So that's the other reason. And the third reason is more technical. I'll cover that in a minute, which is convexity hedge, and some on the markets think that this is the main reason. However, I do not think so. So the key reason is this inflation story, and this is something that we should have our focus on. So why is this important? First of all, obviously yields are very important for all the markets. The reason is that the higher the yield, the more attractive the fixed income becomes. So maybe at 0.55%, which was low in 2020 in August, maybe you think, well, this yield is so low, this yield is so scarce that doesn't make any sense to buy fixed income. However, with yields now around 1.4, and they were, as you saw, even above 1.5 last week, maybe you'd think, all right, maybe right now I'll put more money into fixed income because already this is some interest I'll be interested in. And obviously this is just an example, but this is the way it works. The higher the yield, the more attractive the fixed income becomes versus the other markets, and the more attractive cash becomes, and the higher the bar for other asset prices. Just as maybe a bit of that's a bit of simplification. However, this is the way it works. And if you use the DCF model and you change just one factor, which is the discount rate, and use 10-year treasury as a discount rate in this model, a rise from this low to the yield that we have now would lower the valuations by around 20%, which is, I think, pretty large number, given that the market correction on the indices was like about, we'll see in a moment, but this was like 3-4%. So markets are still relatively benign, and there is certainly potential for a bigger move. Secondly, obviously yields are important for FX, which we'll discuss in a few minutes, and they have the biggest impact on gold prices. Right, so we'll discuss that in a minute as well. But yeah, here is the bit on the negative convexity. I'm not going into it really because I don't think this is the main factor. You can have this read and that should be enough. However, the key thing is that because of the huge QE, a large portion of this mortgage-backed securities, which cause this convexity hedging, and which could technically reinforce this bond yield process, they are held by the Fed and they do not hedge. So for that reason, this story that this is the main driver could not be true. So this is something you might be aware of, and if you want to be more familiar with what the convexity is, you can have this read, but I don't think this is key. So the crucial story is, will this inflation accelerate, and will it stay at higher level, and will the Fed be forced to act in terms of removing some accommodation, which is certainly not what they want. And from that perspective, the tactics that was used by Powell last week is very dangerous. So they are trying to convince the markets that this is certainly not an issue. If you look at the Powell speeches last week, it looks like he wasn't actually interested to discuss inflation. He was interested only in propping markets higher. So he just came out, and the avalanche of his words was like, don't worry, inflation is under control, inflation will be below the goal, we will stay supportive. So obviously that helped the markets. As you can see, indices held up, and of course then they corrected lower, but they are still very high. Like I said, when we take a look at indices where they are now, with US 100 that was most affected last week, it already recovered a good bit of it, and especially on S&P 500. This is not even a correction, this is just a small profit taking. So obviously, from one perspective, you could say Powell was successful, and the Fed, in the broader terms, not only the speeches, but in broader terms, the Fed obviously is successful in pumping markets higher. But the question is, what happens if they are wrong? I think it would be fair for them to go out and say, look, there are some risks, there are some pressures building, but we still think it's manageable. We will see how it works, and then we will act as needed, right? Because that would be fair to all the market participants, and then they will stay credible. Because if there is no inflation towards the end of the day, And if it really is under control, how Powell says right now, then obviously there will be nothing to worry about, and any deeper correction right now would be just one of many that we had in the past. However, with them saying that inflation will be below the goal for at least 3 more years, if actually inflation goes higher and refuses to cool down, they will lose a lot of credibility, and a much bigger market crash could occur. So I would say what he did last week was very irresponsible, and it just adds the fuel to the criticism of his policies. Obviously, this has a lot of impact on the gold market, like I was showing you last week. Maybe let's take a look here. Yeah, last week we are rebounding from this support level, and I said we can have small technical rebound, but the longer direction is downwards, given this downward channel and given the rising bond yields, which means falling bond prices. And we really had 2 very painful sessions on Thursday and Friday, and today we have some kind of recovery. But if you look at the yields, obviously they stabilized a bit as well. However, unless we have this covering here, which still could be tough to do, the situation is tough. For sure, for gold right now, this level 1765 is a resistance level, and the trajectory is downwards. So and it's even for those who would like to catch a falling knife here, it's not really a good level to do so, because as I mentioned before, 1680 would be much better level. So even if you were willing to trade against the trend here, I would rather do it at least having some solid support rather than here. All right, let's move on. And finally, with this bit on the yields, why are those yields important? As you can see, they are very important for valuations. In the 80s, where bond yields were at post-war records, you had very low valuations and very difficult situation for equities. Then the yields were just moving down in a trend, and valuations increased, helped propel indices higher and higher. But you had some situations, I borrowed this chart from Twitter, you had some situations in the past, like today, where you had rising valuations and rising bond yields. So obviously that happened in 1987 and 2000, and you know what happens next. So obviously this is yet another warning that if bond yields rise too much, too fast, then obviously that something much bigger than 3-4% profit taking could take place. All right, let's take a while to discuss forex markets, where these higher bond yields should technically help the US dollar, and that happens on the US dollar to the Japanese yen pair. As you can see here, rising bond yields in the US, which is white line, they rise much faster than the Japanese bonds, the yield on the Japanese bonds, which is the yellow one. So the spread, which is green line, is rising, and that helps a purple line, which is the dollar to the yen currency pair. But it's not like that everywhere. Certainly not on the euro dollar, where the yield differential is becoming less and less favorable to the euro, and the situation on the euro dollar remains I would say unclear. Yeah, let's call it like this. Last week we even had this strange moment on Thursday when bond yields were rising, which should support the US dollar, and at the same time euro dollar broke 122 because some stop losses were cut over here, and it even looked as if we could have reversal upwards on the euro dollar with bond yields on the rise, which would be really, really strange, but eventually it didn't happen. So from here, I would say it still looks like a bigger leg down is possible, because you can paint a flag formation here. So you could still argue, okay, look, this is just a correction in this bigger impulse structure, and a breakout higher was rejected. So yes, these are two strong arguments, but obviously you still need to you still need another breakout this time lower and have it sustained. So we'll see where it happens. The FX market is still very reluctant to move, and I think one of the reasons is not even the fact that the US dollar is still very strong from the historical perspective, which you can see on this chart, but that many institutions have short dollar trades, and that was the second most crowded trade according to Bank of America survey towards the end of 2020, and I think they are trying to squeeze as much of it as they can. So unless there is a really strong impulse dragging the US dollar higher, which should be rising bond yields and declining equity markets at the same time, it will be difficult to move the dollar significantly higher. Okay, let's move to the calendar for this week. We have a couple of very interesting events actually ahead of us. So obviously, calendar-wise, this NFP report on Friday in the US is the most important. I think we are slowly getting perspective on it, because last few months the markets weren't sure what they wanted from the NFP, but I think right now the markets actually want weak NFP. What it means, if you look here, you can see that total employment in the US remains well below the levels that we had before the pandemic. And obviously the Fed, what they are trying to say is, look, there is still a huge gap, so we need to print a lot to cover this gap, and unless this gap is covered, there is no ground for sustainably higher inflation. So if the NFP is actually weak, unless it's dramatic, but it's weak like minus 100 or plus 50, something like this, unless it's really convincingly strong, then the bond yields could decline and could take this pressure off the markets that we saw last couple of days. So this is one of the reasons why I'm very critical of the Fed. What is the result of their policy is that markets actually want weak data, which is, I think, not a normal situation. On top of that, we have ISM indices today and on Wednesday, and with this survey you want to take a look at price sub-indices, because what they reflect is cost pressures on the enterprises in the US. So if these sub-indices rise or they stay very high for the manufacturing, because that was already very high level last month, that means that these costs, the companies will try to carry on these costs to consumers. So certainly this is worth watching. And last but not least is the Reserve Bank of Australia decision tomorrow in the Asian session, so pretty much tonight. This is perhaps something that you do not pay attention too often, but this time I think it is important, because this is the first major decision since this small road on the bond market, and Reserve Bank of Australia really tried hard to stabilize the market, and they managed to do that today because they had another auction, another strong purchases of longer dated bonds, and they managed to bring down yields on the 10-year for the Australian market by more than 30 basis points, which is the main reason why the markets are recovering today in the morning. But we'll see if they will do anything more officially at the meeting, because they extended the QE last time around. It will be probably a bit hard for them to do something big tomorrow. So we'll see. However, even wording will be very important, because if they are aggressive in fighting yields, then the market can extrapolate their language, their message to what other central banks, especially the Fed and the ECB, could do. So this is certainly worth watching, and you can see the reaction tomorrow in the morning and read this in our news section, which is something that I strongly encourage you to do. In the news section, both web desktop platform and the mobile Xstation mobile trading platform, you have a news section where I encourage you to be with us, because we try to cover the market situation from 7-8 a.m. in the morning to 7-8 p.m. in the evening for you every day. So with that in mind, let me wish you a good week, and we see each other next Monday at 7:30. Bye.